look for managers. So the stock market, for instance, is exceptionally efficient. The stock price includes, every stock price includes all the known information about that stock. Mm-hmm. So there isn't anything that we could say about that company that isn't already known by everybody that bought and sold that stock. So the stock price includes all that information. For us, the only thing that's going to change the price of that stock is news or new information. By definition, we don't know what that is. So for any one manager to be able to harvest inefficiencies in the stock market is very difficult and just not common amongst money managers. So most money managers are unable to match or exceed the performance of a simple buy and hold of the stock market. In real estate, I mentioned earlier that if you hold real estate for 10 or 15 years, you've gone through several business cycles normally, and if you sell that property at the end of 10 or 15 years, you can expect a rate of return between 6 and 8% per year. In contrast to private placement real estate, where an expert is able to go into any individual address, find inefficiencies in that address. Inefficiencies are opportunities to make extra profit.
Right.
They're either able to buy at a low price or they're able to buy and add value by painting or cleaning the toilets or whatever they've done.
Right. So basically, there's a cycle that happens with private real estate, if you will.
They create their own cycle.
Yeah. And the cycle for a property is that somebody buys it, if you will, to rehab it. So they come in and they do whatever cleanup that they need to do. And then if it's a rental, again, you can raise the rents because you've improved the value there. And so all these things that you can do to improve the value of the property, and then they tend to sell it to somebody that's looking for income from the property.
Good.
And then, then they run it into the ground, and it goes into the down cycle, and then they sell it because they don't want to pay for rehabbing the property, and so then that next person is going to go through that cycle again. And so we're taking advantage of the up part of somebody that likes to do this rehab type work.
That has actually happened.
Yes.
So a particular manager that we've been using for more than 10 years
Yes.
Sold an address 10 years ago, bought it back about 5 years ago, and is still holding that address. But they sold it to what we call a mom and pop. Mom and pop took all the cash flow, did not remodel, repair, rehab the property, and the property deteriorated, and our property manager was able to buy that address for less than they'd sold it for originally because it had been so mismanaged. And we did that process now on that same address twice.
Now, we haven't really talked about this, but for a REIT, again, it's almost like buying a share of stock.
Yes.
When we're talking about these private deals, we're really talking about almost like a partnership share. It's a limited liability company in most cases. So you're buying a share in a limited liability company, and then one of the characteristics of that is that there's a pass-through that happens related to the income or expenses related to that particular entity. And so, it's just a technicality as far as how the ownership works. Okay. So, what is the role of time and illiquidity for holding real estate and measuring returns?
That's a great question. So if we're going to hold real estate long enough, we're going to get the returns of the same returns that the whole neighborhood's getting. If we're able to go in, harvest inefficiencies with professional private manager, add value to that particular address and sell it and get out in less than, say, 5 years, we're able to get much higher rates of return. We're compressing all of that return potential into a short time frame with private placements. In public REITs, for instance, we don't do that. You buy at or near normal market prices, maybe above, maybe below, but you hold it so long that really the rate of return isn't much different than anybody else that's in the neighborhood. So the buy and hold period is critical to how the investor, my clients, want to get the returns of the real estate. For some of their real estate investment, they may just want a public REIT and get good returns long term.
So then it's almost the equivalent of a bond, you know.
It's got better risk-reward ratio than a bond.
But it's the same sort of idea, less risk than getting in stock market type thing.
Yeah.
All right. Now, as a fee-only financial advisor, how do you counsel clients who come to you with real estate investments that they've held for many years?
Well, as I'd started to say when we got started, Mike, excuse me for
dangerous
throwing the table around. The opportunity is for us to help a client understand the tax and economic consequences of their investments, their choices. So what we do is go back, use as many previous tax returns as we can get from the client to determine, and memory from the client. The client's going to tell us what they paid for the property 15 years ago.
Yes.
And what the mortgage is on it, and what the rents have been approximately. So then we go back and use as many tax returns, and we build a spreadsheet which shows what we think the after-tax internal rate of return has been during that hold period.
Okay.
And what we can expect on that into the future. So once we've got a peg in the sand as to where he's at, that client can then make a choice as to what they want to do into the future based upon the descriptions that we've been talking about. So would they like to sell that property, get out of the management headaches and go into public REIT, or would they like to get greater risk-reward ratio out of a private placement?
Okay. We're getting close to running out of time here.
It's been great, Mike.
Okay.
You've done a good show.
So how do you recommend clients increase expected returns on their real estate investments? 30-second answer.
Wow. It is not uncommon for me to have clients come in and they don't know what else to do but continue to hold their existing real estate. So when we've been able to give them some handle of what we think their rate of return has been after tax, then they take a different perspective on that and are willing to make new decisions about that real estate without being concerned with just the tax consequences.
Yeah.
Which is what they start out saying.
Yeah. So you don't want the tax tail to wag the dog.
Economic dog.
Economic
good.
dog. But the other thing is that with real estate, I mean, it's one of the few things that you actually get some flexibility because you can do exchanges. And so you may be able to exchange out of your little house into one of these private deals, for example.
Yes, we can. So we've done a lot of what's called Section 1031 exchanges for clients, and they can get out, do a tax, they sell the property, put it into an escrow account, and are able to move that money into a private placement, tax-free, tax-deferred.
Okay, we're all out of time. Craig, thank you again for joining me today.
Thank you, Mike.
It's been a pleasure having you. Folks, hope we've opened up your mind to some different ideas of real estate investments, and we hope that you can join us next time for Financial Insider Weekly.